It is a major week for global central banks and the less major ones that Damian will tell us about. But rate decisions we're getting this week from the Bank of Japan tomorrow, the Bank of England and Federal Reserve are also all due. Investors also looking to the Treasury's quarterly refunding announcement on Wednesday. That's going to set the stage for just how much the U.S. has to borrow and just whether we can absolutely absorb it. And then we'll get the U.S. labor market report with a jobs report on Friday, including a slew of other labor market data throughout the week. Andrew Sheets, global head of credit research at Morgan Stanley, is going to be on tenterhooks parsing through all of this. What's most important for you this week?
Thanks. So I think several things are important. I think that confirming that the Fed is pausing, and we do think that the Fed will not raise rates, and that can kind of further reinforce the idea that they are done raising rates for this rate cycle, which we think is important for generating and stabilizing bonds. And I think the earnings season remains very important. I mean, again, you had this kind of interesting dynamic where so far the underlying reported earnings are pretty decent, but the guidance has been disappointing. The market's reaction to that has generally been to punish misses pretty severely. And we've seen quite a bit of idiosyncratic risk coming out of earnings, single stock risk, which also matters. So those are two things that are at the top of our list.
You also mentioned at the top of your list that fiscal policy is key. Across the U.S., across Europe, across China, fiscal policy is playing an elevated role in market dynamics this year. Tell us about your views on fiscal policy.
So I do think the fiscal story is a really interesting one that affects the U.S., it affects Europe, it affects China. And so, we focus on it in a couple of ways. I mean, my colleague Chetanaya, who's our head of Asia economics, it's just some great charts that show just how much fiscal policy in China and the U.S. have diverged, where China's been tightening fiscal policy while the U.S. has been loosening it. We do think that in order to get more bullish on China, we do need to see a larger response, a larger fiscal response than what we've seen so far. In the U.S., I think the real key is how much can the states pick up the slack on the fiscal response side. I think there's a lot of focus, a lot of right focus on, we have these large deficits, these unusually large deficits in the U.S. relative to the strength of the economy. But if you go below the surface, the state and municipality spending actually holds up pretty well on our forecast over the next 12 months. And that keeps, we think, the U.S. economy out of recession and stable even as federal spending pulls back a bit. But I think that's also really important of how you can get a soft landing, even with so much fiscal support from the federal government in the rearview mirror.
And then how does this fiscal landscape actually impact your corporate credit strategy? I mean, obviously, as an equity investor, we're sort of engaged in this conversation somewhat. And there is a concern in the equity universe that some crowding out may occur as a result of these extraordinary deficits and high yields. Are you seeing any evidence of that? Is the fiscal landscape impacting your corporate strategy at this point?
So I think so far, ironically, what's been happening on the fiscal side is I think been helping credit. And I think that's an absolute and a relative case. And in absolute terms, the fiscal support at both the federal and state level, I think is reducing the odds of a recession, has supported the economy. And that's kind of obviously helpful for credit. But I think also on a relative basis, I think something that's been weighing on Treasury markets has been, the income, the carry is low because the curve's inverted. You get paid more to hold T-bills than extending out the curve. And then supply has been very heavy, or expectations of supply are high. And then if you look at the corporate credit market, it's kind of the other way around. The carry on corporate credit is positive. The credit curve is positively sloped. And issuance has been really undershooting expectations as companies, which I think have more flexibility than the federal government to issue or not, are looking at these yields and we think are saying this is expensive borrowing. We're going to try not to do it to the extent we can. So you've seen less supply on the corporate market, especially the investment grade market, which we think is a relatively positive technical supporting that market.
Andrew, if you go back to, call it late June, early July, I think you'd be hard pressed to find one fixed income asset class that was down on the year. But now we look at it and it's a completely opposite story here. The one asset class that stands out to me that is still up on the year is U.S. high yield. I'm curious to hear your thoughts on that, what's keeping it up and whether or not it can sustain its current performance.
So that's a great point. I mean, I think U.S. high yield has been pretty remarkable in terms of how well it's held up on a relative and absolute basis. And I think with hindsight, it's been helped by the fact that yields have been rising, and generally investors, look to high yield as actually a better performing historical sector in rising yields at somewhat shorter duration. And then you've seen relatively little supply out of that market, especially because it's been so expensive for these more levered issuers, and so that's also helped technicals. But going forward, and I think this has been a really key part you mentioned earlier on the show, you look at what's happening at breadth in the equity market. You look at the underperformance of small caps relative to large caps, and I think that's still actually a relatively troubling signal for the future performance of high yield. I think if the equity market is saying, look, we're getting incrementally more cautious on smaller, more levered, more cyclical stocks, as long as that's happening, I think it's hard to see the catalyst to drive further compression or more compression on spreads. So we think spreads decompress from here. We think that there's already a lot in the price of high yield's relative performance, even if we avoid a recession in the U.S., which remains our base case.
Just quickly, Andrew, how concerned are you that Japanese buyers in particular, big corporate debt buyers in the U.S. are going to pull back, especially with some of the adjustments that we're expecting from the Bank of Japan?
So we think that risk so far is moderate, but we do have to watch it. Again, the return on a hedged basis for a Japanese investor into U.S. corporate credit is not good. So we do need to watch that. We do need to see still if the flows on an unhedged basis continue. Our base case is that they do, but I think that's something subject to what we might see this week.